Hi, good morning, clients. Now we're going to start our morning webinar. My name is Te Hong, and I'm covering REITs for PSR. Last week, we just initiated on our first REIT, Frasers Centrepoint Trust. We have an accumulate rating on it, and today's coverage will be on FCT and Valuetronics and technical analysis on gold and oil. But the sequence will be Valuetronics first, technical analysis, and then FCT. So now I'll pass on to Ken to do Valuetronics.
Thanks, Tohong. I promise to make this quick. So the focus can go back on Tohong and his facial trust. So I'm going to jump to my slides quickly. Alright, so for Valuetronics, right? Alright, this story is, you guys know the story by now. We're going to revisit Valuetronics because I think certain things have occurred and which renders this which I believe renders this to be undervalued again, and hopefully the market will realize that. Okay, so basically, as of now, the 9-month 15 earnings have been keeping pace with last year's 9-month 14 earnings. So earnings have not collapsed, and that's actually a good thing, because if you recall, right, 2 quarters ago, there were very overblown market fears. There were overblown market fears that because of a restructuring of a major client, right, that somehow the CE business was going to collapse, or the CE business would be discontinued. So the thing is, that has not occurred. Okay, so because that has not occurred, right, earnings have actually been keeping stable. Okay, essentially the ICE growth rate has been keeping pace with the CE decline rate, keeping net earnings flat. Now, we like to say that for the IC segment, right, which is the main segment now, because the market might not have accounted for the fact that ICE gross profit distribution is already higher than CE, it's already overtaken it. Okay, please note that. Okay, and the IC segment seems to be in the right place at the right time, because the IC segment has a revenue concentration which is overly concentrated in the US, and the US manufacturing and consumer spending numbers are actually really robust. Okay, now the market might not have accounted for the change in business quality, because as the CE continues to shrink and the IC continues to grow, Valuetronics margin will actually increase because of product mix itself. So it will actually grow into a higher margin company in the first place. So based on the fact that IC has some growth tailwinds, plus margins are set to increase because the business is changing, plus the fact that earnings have actually been stable during this transition period, we think that this is actually a good buy. So it's cash rich. The net cash is 55% of market cap. It has a forecasted dividend yield of 7.5%. And we think it's very undervalued. Okay, so right now it's trading at 6.5 times adjusted forward PE and only 3.2 times PE x cash. Okay, so based on our own conservative earnings target, right, we think target price is 49.5 cents, which is roughly 20% more from today's price. And this is actually conservative because only 7 times, and I'm only adding 60% of whatever net cash they actually have. This slide is just for your for your reference, to show you that C gross margins have been increasing, okay, as the IC revenue has been increasing steadily, and the C revenues decrease. Together, net margins increase, and the gross margins increase. Net margins also increase, and the earnings have been, for the last 3 quarters, have been keeping pace with last year's last 3 quarters. Okay. Also, one more thing to take note of is, based on our conservative earnings forecast, right, we are already 85% there in 9 months, so the probability of hitting 100% is quite high. Okay, so that's for Valuetronics. So based on these reasons, we think it's cheap. I'd like to talk briefly just about gold and crude oil. This is not going to be a full technical explanation, but this is more of a case because I just want to, if you haven't seen these reports already, I think that if you want to get our take on the sentiment of gold and crude oil, please refer back to these 2 reports. But to summarize, right, way back in January, we already had said that gold was at the intermediate bottom. And this is before other people had said so. We said the first target was 1250, second target was 1350, and we said this at a time where the media narrative was on balance bearish. Gold price actually reached a high of 1307. It was midway between the targets before retracing back. Subsequently, okay, just hold on for a second. Subsequently, if you look at the 9th of February report, after the price had gone up to 1307, if we trace back to a bear flag over here, so on this candle here, that kind of broke the bear flag. Okay, and essentially we released this particular report, and the main point of this report was that that even though it is at this present support zone over here, okay, now technically we say, oh look, it's at the support zone, it's going to bounce, right? But no, we look at breadth, sentiment, and other indicators to show that it is looking actually quite weak, even though it's at a support zone. So we said that we should have a weak consolidation. We suggested that there should be a continued downside bias. Okay. Now, even though we know that gold can be very volatile, especially on the upside because of the crisis risk, we said that as long as the price doesn't spike up and recover 1250, it should continue downwards. Okay, so this is just the chart originally for gold that we had in January. We showed that this was the bottom here we picked. This is just the chart as of 9th of February. This is for your reference. Okay, and this is what it is today. So today, from here, this is when we put the report. Today, it has trickled down below the support zone, and we believe that as long as there isn't any crisis news, for example, this will continue to trickle down, and basically short-term bias, and we think that below 1200 to 1000, that's the zone where psychologically the market thinks it's cheap. We will revisit gold if it does reach this area over here. Okay, so short-term bearish, and we will revisit gold below 1200. Okay, but in general, we believe the market for gold is such that it should be range bound anyway between 1150 and 1350. Okay, so it can't get too high, it can't get too low. All right. For crude oil, same thing. These are the two reports that we did in January and February. Let's just go to the main points. Main point for the first one was bottom is close but not yet. We called for the $48 support to be broken, and the strongest support is 35 to 40. So essentially, the WTI broke below 48 to a low of 43. Please ignore this line over here before the media emphasizes the Brexit narrative. Just ignore this. WTI broke below 48 to low 43 before pushing back up. Okay, and the second report was on the initial push. Many people thought that the move was a dead cat bounce. Okay, but we think that a $55 target is possible as long as the $50 remains unbroken, and with a maximum upside between 65 to 70. Okay, so since then, this is basically what has happened. Okay, so since then, we note that the price actually made it almost to 55 once, twice, 3 times, and that's where we are now. So we believe that as long as the price stays in this pattern, right, that's actually bullish and might actually hit 55 or above. But we do note that the long-term fundamentals of oil is such that it may take 1 or 2 quarters to resolve itself, and even if it does break above 55, right, we do not think that the trend has on a long term has actually reversed. It will probably continue consolidating within a range. Okay, so if it does break over 55 to 60, 65, you should consider taking some profits then. Okay, so this is yep. So this is what this is what it is for the crude oil. Okay, thanks. I will now pass the mic to our featured speaker today, Teo Hong. Okay, if you have any questions on these reports, these presentations, please go back to read our reports that we were talking that's released earlier. Thank you.
Okay, hi clients, I'm back. So our initiation on FCT. Before I start, let me do a broad sector overview for the three REIT sector, namely commercials, industrials, and retail. So on the office front, as you can tell from this picture, we are seeing that net demand for the past 4 years has actually been dropping, as you can see from the red bar. And this is primarily due to financial institutions not expanding, and also because they're having more alternative spaces like business parks. So they're able to relocate certain functions of the banks like back offices or ITs to these business parks, and that is leading to the drop in demand as well. So on the industrial front, we're seeing the same stuff. We are seeing falling occupancy rates and amidst increased supply. And because of this scenario, we think that in such a case, you actually need to go for the market leaders, and which is why we actually like cash as we initiated a few weeks ago. So last year we saw a huge bump up in the supply for retail space in Singapore, and a lot of it was up in Jurong East area because the government is trying to develop that area. So we saw a very interesting phenomenon in that we are seeing increasingly a lot of international retailers, they are actually moving out from city malls to suburban malls. You have the likes of Kinokuniya, you have the likes of COS. COS is this Swedish high-end retailer. They have an outlet at Ion, so they're actually moving to Jurong East. And you have the likes of Coach as well, and Kinokuniya. So all of them moved to Jurong East for the first time in Singapore. Which brings us to our second point, suburban malls increasing appeal to international retailers. So as you can tell from this chart, I think the chart tells the whole story. From 2009 up to last year, you can see that the growth in the rental index for fringe area malls, the blue line, is actually much stronger than that of malls in the central area. So FCT in this regard, having a portfolio with a full concentration on suburban malls, is going to benefit from this trend that we see. So next, we think FCT has this resilient portfolio with a strategic tenant mix. Resilient, we mean that FCT actually has 6 suburban malls, and out of these 6, 2 of them contribute around 60 plus to 70% of their revenue. And these 2 will be Causeway Point in Woodlands and North Point in Yishun. So when you think Causeway Point in Woodlands, you see that Woodlands and Yishun actually, they are having very low upcoming supply in the next 3 years. And this means that these 2 malls are going to be continually dominant in their respective regions. And for FCT, you can see that the tenant mix from 2010 to 2014, you can see that increasingly from 25% to 30%, FCT is increasing their exposure to F&B tenants. And we think this is actually good because, as you can see from the chart on the left, for the first 9 months of last year, I've stripped out January and February because of the Chinese New Year effect, because you see a very huge volatility in F&B. So for the first 9 months, you see that retail sales for Singapore was actually pretty sluggish, staying pretty flat or slightly negative. But you see that for F&B, they're actually pretty resilient. So in that sense, FCT having a good mix of F&B tenants in their portfolio, I think is a pretty resilient, makes it pretty resilient as compared to its closest peer. As you can see, in 2013, it's only about 20% of NLA to F&B outlets. Next, we think FCT has a sponsor which has exciting properties in their pipeline. Namely, we are looking at Waterway Point. Waterway Point is going to TOP at the end of this year. So usually when a property TOPs, they will take 1 or 2 years of stabilization before they get passed on to the REITs. We know that FCT do not have the right of first refusal for this Waterway Point, but we think that this property in the sponsor's pipeline actually fits what FCT's theme is, that is suburban mall. So we think there's a high chance that this Waterway Point can actually be pushed down to FCT come 2017 or later. So why is Waterway Point exciting? Because it's going to be the main mall in Punggol. It's going to have the first 24-hour NTUC finest, the second in Singapore after Next, and it's going to have the first cinema in Punggol, and it's going to be the main mall in Punggol, serving the 300,000 odd population over there. Lastly, we like FCT for the strong track record. We noted that DPU growth has been positive every year since IPO in 2006, even during recession years in 08 and 09. And CAGR for DPU since IPO in 06 actually stands at 8.03%, which is pretty decent with you. So next up, we do a peer comparison of FCT versus its closest peer. We think that the closest peer will actually have to be CMT because of their concentration of suburban malls as well. But CMT actually has 16 malls, and they are pretty they actually have 4 malls which are more tourist dependent than suburban dependent. They have Bugis Plus, they have Bugis Junction, they have Raffles City, and they have Plaza Sing. And Plaza Sing and Raffles City actually are the top 2 revenue contributors to CMT. So in a way, you can see CMT as being slightly dependent on the tourist numbers as well. So the third one, you see Star Hill Global, SPH REIT. These two, Star Hill Global is a very upmarket mall. They own Wisma Atria, they own Takashimaya. SPH REIT has Paragon, and they have Clementi Mall. So these two will be very dependent on tourist numbers as well. Capital Retail China is, of course, a different region. And Suntec REIT, even though they have retail, but around 60% of their revenue will come from office. So we think the closest match would have to be CMT. And if you compare FCT with CMT, you see that the dividend yield for FCT is higher, trading at a lower book, having a lower gearing, and lower cost of debt as well. Next, you can see the DPU growth over the past 8 years since IPO, over the past 5 years since recovery from GFC, and over the past 3 years, and see how they compare to CMT. Key risks would include, we know that the government has been increasing the foreign labor requirements over the past few years, and this actually eats into retailers' margins. So if retailers are having their margins eaten up, there may be a chance that they would not be able to afford higher rents should the landlords want to charge. And because getting foreign labor is harder nowadays, and this phenomenon will actually could limit their ability to expand, and in that sense limit the entire demand for retail space as well. Next risk we have the non-extension of tax incentives. So these incentives were granted to the REITs in 2005. They were extended once in 2010, and the next extension will actually come next week when Minister Tharman takes to the stage. So these incentives actually come in 3 main forms, namely income tax incentives, stamp duty incentives, and GST rebates. So if any of these tax incentives are not renewed, they could actually reduce the REITs, this asset class, the attractiveness as a whole, and could cause an outflow of funds. So lastly, this is a risk that is common to all REITs, that is the Fed raising interest rates too fast, too soon, and causing a shock to the economy. So all in, we have an accumulate rating on FCT. Target price is 214, representing an upside of 13% over the last close of $2.01. So next we will move on to the big picture going forward. So all eyes will still be on Greece and the talks with ECB. So movements in the euro and happenings in Europe will still be a main concern. And our top ideas for the week, FCT is a buy. Gold, we are short-term bearish and we will revisit below 1002. Valuetronics, we are a buy. So other research ideas we have in the week, we have a reduced call on ComfortDelGro, reduced call on Google, and other results over the week as well. The week ahead is going to be quiet. It's going to be a very shortened, happy week, 2.5 days trading for us and much of Asia. So in the US, we are seeing President's Day holiday today as well. But notably, you need to take note of the results from the corporate giants, namely CityDev, CapitaLand, Sembcorp, over the next 3 days. So with that, we have come to the end, and we welcome questions.
Yeah. Hi, Kenneth here. Just a quick comment on the technical reports. I didn't spend very much time on them, so I couldn't basically talk about the nuances of the call, because I try to compress it below 5 minutes. So my suggestion is please do go back and read the report. They're a couple of pages long and talks about the different nuances of the market and why the call is as so, especially for gold, because gold is in a very interesting position because it's actually in a support zone. See, many technical analysts will expect a bounce in this region. So the thing is, there are some nuances that I talk about in the report itself where it could bounce. It could bounce. So I'm saying that it could bounce or it could break down. That's the thing. It's at a zone where we have to be very vigilant. But if you ask me where the bias is, I will have to say the bias at this point is actually down. Okay, but at the same time, you have to be reactive on this. I wouldn't just say go short and close your eyes. I wouldn't say that. Okay, so please do look back at the report which we released for gold and crude is well worth your time.
Hi, there's a question on Croatia's REIT and iREIT. Croatia's REIT, we actually have a buy rating on it. We came out with a report on it just last week actually, so you can go and refer to it. iREIT, we currently do not have any coverage on it, but iREITs primarily they own properties in Europe, and depends on whether they have hedged their income. And with the ECB now announcing QE and the expected weakening of the euro, this may not be looking very good for iREIT. But I'm not too sure because you need to check whether the details, like whether they have hedged their income and all that. There's another question on rising interest rates. How would it affect FCOT? Generally, rising interest rates would hit REITs in a few ways, right? So rising interest rates mean that REITs will have to pay more interest when on their debts, and there is this perception that REITs being fixed income instruments, when interest rates go up, so that actually makes the use of REITs actually less attractive. So in that sense, it's actually commonly perceived that when interest rates go up, the capital value, the prices of REITs should behave like fixed income and drop. But we have shown in our report, in our FCT report, that there's actually a graph showing the historical correlation between the FTSE REIT index and the SOR rate, which most REITs have their loans pegged to. And you can see that historically you can take the period from 2003 to 2007. So in that period, actually interest rates were rising, and you can see that the FTSE REIT index is going up as well. So the conclusion is that if interest rates go up, and if that is at the back of generally improving economies as a whole, then you shouldn't fear that REITs will do badly. And a second thing to note is that after the GFC, in fact, the REITs have actually gotten more prudent in their financing. You see that the average financing, the average gearing ratio of REITs now is only about 33-34%. They are actually limited by a cap of 35% by MAS, 35% for non-rated REITs, and 60% for rated REITs. So at 35%, they actually, and many of them do not actually even go near, like FCT is only 29%. And many of them actually can tell that interest rates are going up as well. And if you look at their annual reports, a lot of them actually have a huge portion of their debts already hedged on fixed rates. So if you're talking about rising interest rates, you're only talking about whatever amount that they have to refinance for that particular year. Otherwise, the rest of the debt, majority, they will have it already hedged on fixed interest rates. Like for FCT, they already have 80% of their debts hedged on fixed interest rates. StarHue, there's a question on StarHue having a higher yield and lower PB. We have noted that as well, but StarHue, as mentioned before, they own properties in Wisma Atria, in Takashimaya, and also Malaysian, Australian, Japanese properties. So in that sense, we feel like the uncertainty for StarHue is bigger, and StarHue has a higher dependency on tourist numbers because they own upmarket malls in Orchard Road, right? So last year we saw that tourist numbers were actually quite bad because you have a few factors. You have the MAS crash, you have currencies, our biggest tourist group, Indonesians, their currencies weakening. So come this year, we expect numbers to improve, but we do not see a huge uptick in tourist numbers. We look at the catalyst this year, and we do not actually see a lot of huge pull factors that is going to bring our tourist numbers up by a lot. We have SG50, we have the SEA Games, we're gonna have major sports events by the Sports Hub, but if you look at it, like in October last year, we already had this WTA tennis competition, and we had the likes of Serena Williams and Sharapova coming in. But if you look at October tourist numbers, you actually don't see a very significant increase. Not just from the Chinese visitors. Chinese visitors going down, we can understand why, because of the MAS issues. But you see that for the other nationalities as well, you actually do not see huge upswings as well. So in that sense, we are not expecting a very bullish number on tourist numbers this year. But that being said, Orchard Road has a very low upcoming supply, so it depends on how you see it. There's a question on FCT at 214. What are the risks involved? So if you look at the report, historically on a price to book ratio, FCT is currently trading at around 1.02. So over the past 4 years, from 2010 to current, you see that the average, the minus one standard deviation from the average PB actually has acted as a support quite nicely over the past 4 years. And right now we are seeing that it has rebounded off that support, of that near 1 PB support, and is moving up again. So I think that could be a clue there. And yes, my estimate for the upside includes the dividend yield. So I'm going to touch on the tax incentives now because there are a few questions on it. So basically, the tax incentives that are granted to REITs, they fall into three broad categories. The first one, you have income tax incentive, namely like foreign institutions, when they buy Singapore REITs, they're taxed at 10% instead of the usual corporate 17%. And then secondly, you have stamp duty. REITs are not expected to pay stamp duty on property purchases currently, and whether this will be renewed or not next Monday is a question mark. And the third one is actually GST rebates. But the big two categories we would say are the stamp duty and the income tax. We do not think the income tax incentives are going to be taken away because, as you can see, what the government is trying to do as a whole since the REIT sector started in Singapore is that they have been trying to very actively promote our REIT sector in giving attractive tax rebates. And you can see that in last year they actually issued this consultation paper as well, and in that paper they actually proposed suggestions like standardizing the gearing ratio for all REITs regardless whether you have a rating or not, and then improving the transparency of REITs. So all this actually what they are trying to do is actually, I see it as trying to improve the transparency of the sector, improve the attractiveness of the sector to investors, and improve the operational flexibility of REITs. So on the back of what they are doing in the consultation paper, I think they are still trying to keep the REIT sector attractive. Right now we have grown tremendously since we started. We are number 2 in Asia now. We are behind Japan, but we are 2 times Hong Kong size now. But I think with a lot of other regions coming out of their REITs and trying to actively promote their REIT sector, we think that the government wouldn't do anything to derail our REIT sector at the moment. And the stamp duty waiver, if it is removed, it will only impact the REITs if they do property purchases going forward.
Hi. Hi, this is Songkai here. So we have a question on United Engineers. Just to recap again, on 4th November 2013, we actually had a non-rated presentation in the Monday archives on United Engineers. Back then it was about $1.85. Okay, so if you just refer back to the presentation, our conservative RNAV will be about $2.80, and since then they have divested quite a lot of the segments of WPL. So we haven't followed up since, but the roughly RNAV we have increased to about $3 versus today's $2.70 per share. That is quite a steep valuation. If we use that as a benchmark, we'll be trading about 0.9 times RNAV. It will be one of the highest of the property counters in Singapore. Going forward, now that the Thai Bev owner and OCBC doesn't come to an agreement, share price has dropped by about 13+% in the last 2 hours, and we don't expect any M&A agreement to come out anytime soon. So that will not provide any pricing support. Thank you. Hi. Okay, just to wrap up the presentation, we also have some readers. They're asking about Noble. Okay, Noble, for record, this we actually read this report published by Iceberg Research. Okay, so what readers can go online, go to Google and Google for Iceberg Research and Noble, and you will see a very bearish report with a target price of 10 cents. Our house don't cover it, so we don't have any comments, but we will direct readers to refer to that bearish reports for further information. Thank you.
Okay, if there are no further questions, we will wrap up the session. Happy New Year, everyone, and have a great trading year ahead.